Welcome to Kentucky Horsepower, the official podcast of the Kentucky Automobile Dealers Association. Hi, hello again, everybody, and welcome to another edition of Kentucky Horsepower, the official podcast of the Kentucky Auto Dealers Association. I am your host, Jason Wilson, president of KADA, and joining me today is Kevin Tynan, director of research at the Presidio Group. Kevin, good morning. Thanks for joining us. How are you on this cool December morning?
I'm doing excellent, Jason. It's always good to see you.
Good seeing you. So, look, we talk often throughout the year. You've been a mainstay at our conventions and addressing things, which always works out to be a nice half-year mark. You know, we're always meeting in June, and we can talk about kind of what's been, where things are going. Now here we are in December. We can talk about what's been, where we're going. And I thought, given the timing of all that, this would be a great time to kind of go through these main items with our dealer body and share your thoughts. And as we were talking before we started recording, essentially, the main stage or the main items that we'll focus on in this conversation are new cars, used cars, F&I, fixed ops, the main things that dealers are always keeping an eye on, and kind of how things have been in 25 and what it might look like moving forward in 26 based on all the factors that you research and study on the regular, so we don't have to. So with that, why don't we start with new car, Kevin? How do you see 25 shaping up from a new car standpoint, and then what can we expect to see in 26 from your perspective?
Yeah, this will be, I think 26 will be the most different year in an organic way, though, right? I think 2026 has the potential to wind up looking a lot like 2019 and pre-pandemic, which was, right, we've dealt with, or the industry has dealt with, this supply constraint really since the first quarter of 2020. And that constraint put supply and demand in such a tight balance that it was beneficial for OEMs and for the dealers in terms of pricing power and margin integrity. And unprecedented, right? We saw an entire year of every manufacturer above MSRP. And great while it lasted, but now there is no real supply constraint anymore other than discipline from the OEMs. So the risk we run in 2026 is this return to production and oversupply killing pricing and margin, because the capacity exists now to build more vehicles. Now, what I've done, looking at the research and the numbers historically, I put that real healthy line. It's not break even. It's more of an equilibrium around 16 million units, which is exactly where we are in 2025. We might finish at about a 16.1, somewhere in that range. But if you look back historically, and if I go back to the turn of the century, year 2000, we've averaged about just below 1.3 million units a month, not seasonally adjusted. If you multiply that out, that comes right to 16 million.
Yeah.
Right. And now when you think about days supply and pricing power, if we average 26 selling days per month, it puts inventory right around 3 million units, right? And that's exactly where we are right now. Actually, the past couple months, I just looked at the numbers for December 1st. We're about 3.3 million. So inventory starting to get a little bit frothy, and we can sustainably and healthfully, if that's a word, sustain that 1.3 million units, right? So now we have too much supply. Here's where pricing starts to break down. And what that means for me is that you can always sell more. And there's benefit for the franchise base to be above 16 million, right? You create F&I customers, you create future service customers, you trade-ins, it supplies your used vehicle segment. So I get it, right? There's a benefit for selling more new units. Profitability is not one of those benefits for the OEM or for the retailer. So I feel like 2026 is the year where now the franchise base, knowing probably what the strategy of the OEM will be, which will be to utilize some of that capacity, push inventory a little bit higher to the detriment of profitability, will now have to pivot to some of those other business units. Right now, used becomes a little bit more important. F&I becomes a little bit more important. Fixed ops become more important
Yep.
because front end gross from the new vehicle segment is going back to pre-pandemic days, which were not great by those measures.
Right, right. The other part that is an important factor with it as it relates to new car sales, and having the luxury as a dealer in dealing with supply being what it was, market being what it was, your sales staff has to really sell again. They have to get back to demonstrating, doing good demos and going through the process where you could argue over the last several years, it was more of an order taking situation as a salesperson versus really having to work the sales. So training becomes an important factor in that too, I would think.
Yeah, and look, I think the key point to that, Jason, is that selling will be, you know, volume will be there, right? 16 million, okay, good market, healthy in terms
Yep.
of unit sales. The question is, what do those deals look like, right? And I think that's what's important for the franchise base is to be more efficient in your operating expenses, right? When you think about how it works, right? You buy a vehicle for inventory, you sell it, that's your gross margin. Your gross margin
Yep.
is going to be difficult. That was easy through the
Yeah.
pandemic, right? We bought it for a certain amount, we sold it
Yep.
over MSRP, and our gross went to a record unprecedented level. That world is over, right? So finding it at the gross line is not going to be possible. What you're going to have to do is say, okay, here's my gross profit. How do I sort of rationalize my expenses in my operating lines
Right.
and keep more of it for my operating profit? And that's where I think a lot of, we see them all the time, at convention, right? All the software companies and the
Oh yeah.
technology companies. I think that's where it's going to come from, not in just the new vehicle segment, but also in used valuation tools,
Yeah.
scheduling. I mean, down the line, that's where I think it's going to come from in this next window for the franchise base. In the pandemic period, you bought it low, you sold it high, right? And it was all
Right.
about gross, front end gross. That world to me is over. Now it's going to be about the operating lines and where do we go to create efficiencies, productivity in our service bays, right? All down the line is where to
Yep.
me 2026 is going to be about that.
Yeah, strategic. I mean, everything, every aspect has to be strategic. Every decision has to be strategy based. Let's talk about used cars a little bit. Let's take a look at that. What you saw in 25, and again, where you see that maybe in 26.
Yeah, and I use the off lease market as a proxy, and I get it. It's not the entire,
Sure.
35 million, including peer-to-peer transactions. But, and I have been talking about this a lot, is that, when the pre-pandemic period, we averaged 17 million units, new units per year. We averaged 30% lease penetration. So every third year was 5 million off lease vehicles, 5 million off lease vehicles. So when you look at 2025, considering that 3-year average lease term, what happened in 2022 was peak profitability for the franchise base and also for OEMs. What you had was a 13.8 million unit market, down from 17, and because MSRPs, the consumer was paying over sticker, there was really no incentive, right? There was no cash on the hood, low rate financing. It wasn't
Right.
necessary to sell vehicles. So where we were used to a 30% lease penetration market at 17 million units, we had a 13.8 that was about 17% lease penetration. So what you had in 2025 is 5 million off lease, 5 million off lease. 2025 is 2.4 million. It's half of what we were used to in the off lease market. Obviously, you can imagine what that does for pricing. It just tightens up
Sure.
everything. Very difficult to acquire vehicles, at affordable levels when that's the case. And then you have to consider the strategy of a Carvana, which has sort of become a bank and is
Right.
funding all these acquisitions and approvals, and then CarMax as well, who need used inventory. So pricing was the worst it's going to be in 2025. The good news is 2026, we get back to 2023 was a little bit higher. I think it was a 15.5 in that ballpark. Incentives came back a little bit, so a little bit more lease penetration. So that off lease segment goes to 3.1 million from 2.4. So think about 700,000 additional off lease vehicles. Those
Yeah,
usually end up being the CPO. So those are the late model, low mileage, high technology. So that's sort of the best of the best of the segment. So you'll get a little bit of relief. I think you'll invite more competition in terms
sure.
of acquisition, but it's the first year since 2021, I think, where we have an increase in off lease supply. So not quite back to where we were, but improving in terms of the flow of off-lease vehicles, which will enable the dealer to at least consider that pivot to the used vehicle segment a little bit as the price and profit dynamics in the new vehicle segment continue to sort of settle. I won't say erode, but they're going to settle at a lower than the peak, but better than the trough, kind of level.
Yeah.
But that's not the point is that the earnings growth that came from the new vehicle segment for the retailers isn't going to come from there in 2026. It's going to be these other segments, and used at least is getting a little bit more supply.
Well, that's certainly welcome news. As you said, I mean, it's been several years since we've seen that, and given the juxtaposition of the new car market and now where the used is going, it's great. But again, going back to kind of that initial, every decision is going to have to be strategic, including how you're going to acquire these vehicles, what methods you're
Right.
going to use to acquire these vehicles, because there will be greater competition for these vehicles.
Yeah, valuing them, right? And logistics, right? So bringing those basis points of margin at every point of the process is going to become extremely important in 2026, right? It's not this free for all where you had, the new vehicle market coming in, inventory comes in, it's gone in the afternoon over
Right.
MSRP. The used vehicle market, you could offer low on trade-in, sell it, recondition it quickly and get it out there, right? So this is really much more to your point, strategic in how you're going
Yeah.
to handle those problems. The good news is that the tools are out there, right? I mean, there's a
Right.
lot of them, and AI is like every other word out of when you're at convention about how it's going to help. But legitimately, like that's where it's going to come from, is creating efficiencies in your process, improving productivity. But I think more and more you're going to see that the ability to appropriate value a trade in, get it reconditioned, and get it sold at retail is going to be more and more important. And the tools are out there to help the franchise base do that.
Yeah, for sure. And you mentioned that AI piece. I'm going to come back to that here after we go through these couple other things, because I do find that to be a really interesting conversation. But let's talk about one of the, you know, the one a couple of departments there that deal with both new and used and every aspect of the dealership operation. And let's start with F&I. What do you see in the F&I standpoint, from again where we were, where we see that going, and how much more important? That's always an important department, but where do you see that in moving forward?
Yeah, look, and that increased activity in the used vehicle segment will help. I don't see affordability coming back. So when you look at the volume of loans in turn, you can think about it the way you think about the new vehicle segment. Maybe units are down, right?
Right,
Originations might be down, but the value of that revenue pool will continue to increase.
right,
Um, we are hearing talk of rate cuts, right, which is a big deal for the
sure,
franchise base as well. So a little bit of relief there, not a ton. I feel like everything is always inflationary. So I was listening this morning and to some financial news, and I think the market is pricing in 3 rate cuts in 2026. I don't know that that's possible given the inflation environment. We're
right.
expecting one imminently. So there'll be a little bit relief on that. But I think if new vehicle supply is or demand is constrained a little bit, and you're losing some F&I originations there, I think you'll make them up on the used side as well going forward. And then lower interest rate will help on the, on the floor plan side of things as well. So again, to your point, right, it becomes about being an efficient operator at that point, and really understanding the movements in the markets and in interest rates, and where you're going to make up for the loss of that front end gross on new and on used. But the one thing I would say, and I've been saying this for a while, is affordability is not coming back. So the idea
Yeah.
of a lower transaction price in the new or used segment is not coming. So this idea that, well, prices are going to drop and volume's going to shoot through the roof, and there comes your originations and your F&I activity, I just don't see it happening. I think if anything, you're going to have more of the same, which is automakers selling fewer units but at higher transaction prices. And I talked about this at convention. The scary thing for me is, what is the technology that convinces the consumer to spend more, right? And it was supposed to be electrification, and that hasn't worked out. So I feel like
Right.
there's this little window where it may not be subconsciously, but the consumer is saying, well, why am I paying more? The answer now would probably be tariffs in the near term, but I'm not sure the consumer is seeing that new technology in this little window. I think it'll come in terms of hybridization and fuel
Right.
efficiency. I think we're going to get this little bump for the OEMs in the intermediate term from the relaxation of the CAFE
Yeah, I was going
standards.
to ask you about that because that made a bunch of news, as you know, just last week. In fact, in the Oval Office, the president made that announcement regarding production cafe standards. Our NADA chairman, Tom Castriota, was in the Oval Office, kind of representing the car dealers there as part of that. I was going to get your take on that. Sounds like you think there's going to be a little bit of a bump there that would be sort of an intermediate
Yeah,
benefit
a
to
bridge.
OEMs and will trickle down as hybridization. I hadn't heard that term yet, but yeah, that seems to be more the direction we're going versus full-on electrification, hybridization, which, look, it makes sense, right? And we've talked through this. I mean, through the years, it seems that should have always kind of been the answer before going straight from ICE to electrification.
Yeah, well, and I think part of that too, and this is stuff I'm always kind of thinking about. I think some of that was the keeping up with the Joneses being China,
Yeah,
right? Which was, hey, they're transitioning their entire mobility fleet to electrification, and if we're not doing the same thing, we're falling behind. The
right,
reality is it doesn't work here the same way it works there. Same way that full-size pickups and SUVs work here for for the buyer, for the OEM and for the dealer, and they don't work in Europe, right?
right,
It's just different macroeconomic dynamics in those regions. Same thing with China. So the idea of forcing electrification on the timeline we were trying to do it to keep up with China, I think was a mistake, or will be a mistake if we continue to do it. Where what we do is what we do, which
yeah,
is big stuff. If we can make it more efficient, that's fine. And that's, I think, the way we should be going forward with this, to your point. But now here's the issue though, is that this the US market hit 80% truck versus 20% car in September of 2021. September of 2024, it was still 80%. Right now it's
mhm,
84%. So we've wrung out these last, 400 basis points in market share or segment shift to
right,
truck. The question is, from 84% now, and make no mistake about it, Jason, that mix shift from 50-50 in 2013 to 84% today has been the driver of earnings for OEMs and dealerships, bar none. It hasn't been more volume, it hasn't
right,
been electrification, it has been truck versus car. So the
yep,
reality is, as we get to 84%, cafe lowering those cafe and emission standards gives a little bit of a bridge, a bump, but there's not a lot of runway left above 84%. Can it be 100%? Sure. But like if you look at Ford and GM and the Stellantis brands, they're already 98%. I mean, there's a handful of cars left from those manufacturers. So the
Yeah.
big moves to truck from car, and the import brands, the Europeans and the Asia-based brands are not going to break into the full-size pickup space. Those are
Yeah. Yeah.
mature and those are segmented the way they're segmented in terms of share. So there's not a ton of runway left to go, even with the easing of these standards. I think what it does is it removes a little bit of the uncertainty of having to build things that you really don't want to build and
Right.
sell because they're not profitable, because you have to hit some arbitrary fuel economy or emissions goal. So it takes off that burden a little bit, but I'm
Yep.
not sure it's the long-term earnings driver that it has been for the past 12, 15 years going forward for another 10, 12, 15 years. I think we still need a way to develop technology that convinces the consumer that they're paying more for something of value.
Right. Right. And it really does the consistent thing in every one of these topics is affordability, and that we're not going to that's not going to go backwards. Any way you dice it, cut it, whatever you look at, which is part of the I think the reason that people are keeping a lot of eye on in our industry as it relates to what China is doing, what that could look like, because of that partnership they have right between and those listening, not watching it, the air quotes between the Chinese government and
Right.
manufacturers, and how that's so very different than in our country.
Yeah, yeah. Look, and we're not going to out electrify China.
Right.
It's if you ask me, that war is already lost, right? They own the supply chains, they own the mines, they own the materials, right? They own the intellectual property, the battery. Like it's, I almost think that the failure of EVs in this country has actually been a good thing for our domestic auto industry, which which to me says, okay, we can do what we do. And what we do
Right.
is big internal combustion. We'll add
Yep.
some hybridization to it, but we're doing big stuff because it's what works with our market, right? And if you look, at Ford and GM, the past couple years, their presence in Europe is significantly reduced. Their presence in China is significantly reduced. And the simple reason is because as a global manufacturer, you want to share as much technology, platform, parts as possible. What
Right.
works here and is extremely profitable doesn't work in Europe, right? It's
Right.
narrow roads, it's $10 petrol. Like
Completely
it
different.
doesn't
Yeah.
make sense. It's a very different market. So the idea is like, well, maybe electrification, which works in China because they've built the supply chain and they own the mines and the
Right.
intellectual property, makes sense for them. Maybe it's a similar story where it doesn't necessarily make sense. Certainly not at the pace that we're trying to do it, right?
Right.
Where it was by 2030, we're going to be 100% EV, or 2035 or whatever it was. Like there's definitely a use case. It makes sense. I'm not sure it makes sense for it to be 100%. The technological singularity of our drivetrains has to be electric. And again, I
Right.
feel like that's a little bit of, technology shaming. I don't know if that's a China narrative or our own media that's saying like, well, we've fallen behind, and
Right.
electrification is the future. And it's like, okay, well, maybe it'll be the future when we need it to be the future, but we need our own mines, materials,
Right.
processing. We can't rely because it's just moving the game to somebody else, right? Oh, well, we're dependent on foreign oil. Well, now we're dependent on China's supply chain,
Right.
right?
Right.
So without building our own, we're just giving away the industry, in my opinion.
Well, and the other point too, you talk about these other countries and how they're made up, and the makeup is so different than our country. We are still a very young, almost 250-year-old country, is all right, and we still have wide open, vast spaces where we're not on top of each other. We don't have the tiny, narrow roads as a The majority of the country does not look like that. So it is a really different, just geography has an impact on how this stuff moves.
And choice, right? Like,
Right.
that's one of the things. That's one of our things. Is like we have choices. And I'm not saying that, electrification is a bad idea or it won't work. I'm
Right.
just saying that to force the industry from one singularity to the other, um, you know, by the government doing it, and then and then if you think about the way that China did it, to your point earlier, is subsidizing it, which we're not going to
Right.
do, right? We're not going to directly subsidize our manufacturers to do this, yet they're going to force it to happen by penalizing or subsidizing the consumer, where I've done the math and since 2000, I think 2009 through 2024, China was averaging $18,000 per vehicle directly to the manufacturer. Our government
Wow.
would never do that, right?
No.
We're having trouble funding, roads and schools, and now we're going to give big corporations, billions or trillions of dollars to do it. It's just not going to happen.
No.
So it has to happen. It has to happen more organically, maybe the pursuit of profit, right?
Right.
So if a manufacturer is losing money doing it, and look to that point, right? We've seen it with the Ford Model E unit has lost $14.5 billion in 3 years, not quite 3 years yet.
Yep.
Lucid still and Rivian still struggling to make their bill of goods to be profitable
Right.
at the gross line, never mind at the operating line.
Sure.
So
Sure.
I'm saying is if it's such a difficult hill to climb in terms of profitability, how does it get easier when we don't own the materials, the mines, the supply chain, right? How does that become easier without us actually building our own infrastructure to support that end of the value chain? And until we do that, you know, China sets the rules, right? They own the process. So I'd like to see, I think the hybridization of it is a step along the way until we can get there at our own pace.
Yeah, look, I think you made a great point, and perhaps the downsizing of the electric side of things is a good thing, long term wise, and going in the right direction, and is a benefit to the OEMs right now versus continuing to try and chase China and all the things that you laid out as to why that's a losing proposition at this point, for sure.
Well, and I think also, why I say it might have saved the industry is because now let's say we want electrification, and this is what's happening in Europe is okay, so China manufacturers are invited to sell their vehicles here, and which is, it's different for the franchise base because you can raise your hand and say, yeah, I'll take a BYD or an XPeng franchise. It's different for the OEMs, right? That volume's kind of a zero-sum game. So so now there's subsidized electric vehicles from China being compared to not subsidized vehicles from the US manufacturers or European manufacturers, and they don't stack up, especially
Right.
for half the money, right? Throw in an extra $18,000 and you're comparing a $20,000 vehicle to a $40,000 vehicle, which isn't even as good. So
Yep.
now the consumer and the media get a hold of that and say, well, their product is just better. And now, from the OEM perspective, is we lose the electric vehicle segment, which we're saying is going to be 100% of everything. So now we've lost the whole thing, right?
Yeah.
And that's the fear is that the consumer will say, right, and this is what a trade war is. And tariffs are about is, well, do you want a cheap, affordable thing or do you want a job, right? Because
Right.
that's what the tariffs are trying to do, are to protect jobs. You
Yep.
can have this cheap toaster, electric vehicle, whatever, but it's one less thing that we're manufacturing here. And
Yep.
so that to me is the debate. It's not about affordability. Tariffs are not about affordability, right?
Right.
It's about protecting manufacturing.
Yep, that's a great context in which to put that in, and too often gets lost, kind of between all the dialogue, the politics of it all the things, which is why we like talking to you to sort of cut through some of the clutter on that stuff. We talk new, we talk used, we talked F and I. Let's talk fixed ops. that's now becoming more important than ever once again. And dealers that were really effective in their fixed ops areas and had the absorption rates where they needed and all those things, great. If you're still operating that, great, fantastic. If you haven't really been that great in that area because you've done so well in the front, it really is time to buckle down on that, right?
Yeah, look, and when you just look at it by the gross margin profile, you're struggling to get anywhere near double digits in new and used these days.
Yep.
You're putting 50 cents on the dollar to gross in your fixed ops, right? So it's just bang for the buck. It's, and when you look at it, it might be, I don't know, in the teens in terms of revenue percentage for the franchise base, but it's like 40% of the profit.
Right.
Now, the issue there is that, as we always say around the office at the Presidio Group is, your margin is my opportunity. So now you're going to start to see a lot of competition in that space because it's so profitable. And
Right.
again, I think this is where those efficiencies, uh, diagnostic tools, scheduling,
Yep.
like it's going to be in the operating line, some investment to make you more efficient, more productive. Because I'm getting this like, I'm still going through the numbers on it, but I feel like there's a phenomenon that's happening in the fixed op space that's similar to the new vehicle market. And this is what I mean, Jason, is that you have a finite number of service bays. So as an operator, you're saying, do I fill up those bays with cheap oil changes? And you get them in, you get the wheels off, you get underneath the thing, and you can say like, hey, you're going to need this, that, and the other thing, right?
Right.
Right. I understand the benefit of doing that. But if you have a finite amount of capacity, you want to
Yep.
use it with your most profitable things. Exactly what the OEMs have done with moving up market to truck from car is to
Right.
say, if we're going to sell things and we're going to manufacture things, we want to manufacture our most profitable things. It's like the chip shortage. It's like, well, if we have a finite number of chips, we're going to put them in our most important vehicles in terms of
Yep.
profitability. And I feel
Yep.
like that's happening. So some of the reports that I'm seeing is that the franchise base is losing ROs, or ROs are declining in fixed ops. And I'm saying, yeah, but it looks like margin is wider and the revenue pool is larger. So is that a little bit of the same thing where the franchise base is saying we're not going to compete with Jiffy Lube
Right.
for the cheap oil change, right? Our bays are too valuable in terms of earning potential to tie up, and this is just business economics 101, right? Like you
Yeah.
go back in the day, you know, uh, a supplier, are you going to pay a UAW worker $100 an hour to make a $4 oil filter, right? Like the
Right.
economics are very difficult. So it's the same thing with, I think, the service bays, I got to get a little bit deeper into the numbers to see it, but I feel like there's a little bit of that, right? There's a finite number of techs, right?
Yes.
So there's
That's a huge problem right now, as you know. As many are aging out, retiring, all those things. Where's that next generation coming from?
right, and if you think about that, so if there's a finite or supply constraint of techs, you have to pay them more, right?
Right.
You have to pay them more. Now, is this somebody that you're going to put in a bay to do $20 oil changes?
Right.
Right? It doesn't make sense. So I feel like there's that dynamic sort of happening under the surface there. The numbers are a little bit more difficult to prove out compared to the new vehicle segment because you can just see what's selling, what the transaction price is, and so on. In the service bay, it's a little bit more difficult. So I think that it's it's in this place which is similar to the new vehicle segment, which is you may not see as much work, but I think the ability to upsell and say, "Hey, look, we are the factory branded shop.
Right.
We have the proprietary technology and tools to work on these
Yep.
vehicles. This is what those tools are telling us your vehicle needs, and here's how we can go about that, right? So that level is something that you're not going to get at an independent or, a quick lube or tire store, right?
Sure.
So I feel like the value of the RO is going to go up. And that may, and just again, business economics 101 will tell you, well, your volume is going to be down, right?
Right.
And that's when you think about it, you're going to grow your profitability or your revenue pool one of two ways. You're going to do more, right?
Right.
But that means you have to charge less, or you're gonna do less, which means you can charge more. And I feel like that the fixed ops side of things is moving in that direction, which is we just don't want or have the capacity to fill our service bays with low margin work. We'd rather do more, we'd rather do less high margin work. And I think that's a little bit of a trend that's happening now, and will continue probably into 2026 and beyond, right? So what you would see is revenue pool, and this is what we've seen in the new vehicle segment, right?
Yeah.
17.5 million in 2016 was only a $35,000 per unit segment
Right.
market. Now we're 16 million, but we're $49,000. So you say, oh my gosh, where did 1.5 million units go? It's like, it doesn't matter. They're worth 46% more per transaction. The revenue pool is expanded by $170 billion by actually selling fewer units. And I think
Right.
that's what we're going to start to see in fixed ops is doing more with fewer ROs.
Well, and that's one of the things that, as an association, and myself and a lot of our peers look at as well from the standpoint of you have customer pay work that goes through the service department, and then you have OEM pay work, i.e., recalls, warranty reimbursement. And while many states have language that OEMs are to pay retail, there are so many inconsistencies and variances from OEM to OEM that myself and others are looking at ways to try and level that playing field, because you do have a finite number of techs, a finite number of bays, all those things to consider, and that can't be a drag on the system. Again, just trying to look at things in a way of that's fair and being able to maximize those opportunities that come through the shop.
Yeah, and look, I get in all the things I do, I get to sit in on some of these sessions where even these things are just being discussed by the
Right.
associations. I was just with the New York group last month, and it's just they're talking about this very issue. Virginia
Yeah.
talks about it all the time, and it's just, to me, my head spins like, the fight that you guys have to put up just to
Right.
get sort of what what you're owed is just amazing. And the crazy thing to me is that, like you said, it changes from manufacturer to manufacturer. It changes from state to state. Like I've
Right.
I've pulled I've pulled dealers aside and said, like, how do you ever find time to sell a vehicle, right? Like when you
Right.
think about the compliance and the regulatory environment, heaven forbid you're a dealer that owns stores in more than one state, right? You have completely different departments for each state. It's amazing,
Right.
but to your credit, it's amazing work that the associations do. It's why I
Yeah.
enjoy going to all of those during the summer, during the season, just to sit
Yeah.
in on some of those things. And all the how the sausage is made isn't pretty, but it's amazing.
It's not pretty, that's for sure, but make it we must, and we'll continue to try. Hey, one last thing I want to touch on with you before we part ways here today, and in your role, one of the things you do routinely, and you mentioned it earlier, is going back as far as 25 years, right, and looking at data and determining, hey, we are where we are. It's been this way for a long period of time and whatnot. Uh, so now, as it relates to this AI conversation, where you don't have the benefit of that because this AI thing is growing and exploding exponentially year over year over year. So there isn't one of those. This truly is one of those. There really isn't much past performance to be able to establish or forecast what future results might be. All
Yeah.
that said, everywhere you go, it's all about AI in every aspect of the business, and we're going to see a lot of it here when we go to NADA here in about 8 weeks or something like that down the road. And that's all we're going to hear about at every booth that you go to. From your perspective, what are your thoughts on it? What I'm seeing is it's everything from the magic bullet to everything that's going to cure anything that ails you. It is the ultimate in all things. And it's in some areas, it may be really helpful and great. Other areas are still that there's always the human part of it, right? There's the science, there's the human part of it. You're always going to have that. So I guess I'm trying to set this up in a way to sort of just get your overall high level view on AI, knowing that our folks are going to be all heading to Vegas here in 8 weeks, and that's all they're going to hear about. Are there anything they should be looking at in particular, considering you talked about some of the things earlier in each of these various departments, but what's your take on it as a whole?
Yeah, like it's good. Remember a couple years ago, everywhere you went was like all in on EV, right? It
Yeah,
was just like you couldn't like any convention was what there wasn't one sentence or 5 seconds of a presentation that wasn't about EV, right? And
right,
that's what AI is now. What I would say is the way I look at it is that to your point, going back 25 years is how long I've been doing this, but I also enjoy looking at the history of the auto industry, going back and of business overall, right? My MBA is in finance, right?
right,
So um, the the physics of business don't change. The rules of supply and demand, what that means for pricing, what that means for margin, since the beginning of time. I joke that supply and demand have been the driver of profitability since we were trading stone wheels for saber-toothed tiger pelts, right? If you
right,
had too many of one, it wasn't worth as much, right? And that's,
right,
one of my favorite books is Lee Iacocca's autobiography, which published in like 1984, but he's talking about lessons he learned in the 1950s, late 40s, early 50s, coming out of World War II, where automotive production was switched over to the war effort. And then
right,
coming out, there was an undersupply of new vehicles, but still great demand. GIs are coming back with money, and it was like that was probably the last time the industry was over MSRP. And it's like, yeah, supply and demand matter. So what I would tell the dealer base is don't ignore the principles of business economics. They do
right.
not change. You have to understand if your OEM is flooding you with product, it's going to have an impact on their margin and your margin, right? It's just the way
Sure.
it is. What I think AI can do is those efficiencies in the operating lines. I don't think it's going to drive gross at any level, right? You're not going to have any time that we're going to see it, cars make themselves, right? It's just not going to happen, right? It's going to
Right.
cost money for materials, for labor, for processes. It's so your gross, we're not going to see this explosion in gross margin across the board, not only in this industry, but in any industry. Um, so I think what you're going to get is the ability to say, okay, if my gross margin is my starting point, how do I keep more of it, right? My earlier
Right.
point.
Right.
And I think that's where AI is going to come in. Can I schedule faster, more efficiently?
Right.
Are we eventually at the point where the vehicle senses its own problem and orders the part and makes
Right.
the appointment? Fine, right? Like that, maybe we get to that. Now, is there implications for the human resources? Could
Yeah.
very well be, right? And I think that's one of the things that the OEMs and the dealers will have to think about, which is to say, where do I put my human resources? Where's the next growth opportunity, and how do I use them for that, as opposed to having to get rid of these commoditized jobs, right?
Right.
Because jobs become commoditized throughout history all the time. Again, business, that's just the history of business.
Right.
Now, what good, successful companies do is they see that in advance and they redeploy those human resources in the next growth opportunity,
Yep.
whatever it is, right? And then you can say, like, look, we've never had to lay people off. We move them from the commoditized job to the growth job. And I think that's probably what's going to happen a little bit, right? So you're not going to have somebody, wearing a headset, making a schedule, typing with one finger on a
Yep.
computer.
Yep.
So, but there's going to be other places for that person to go that that they can be sort of redeployed. And I think that's what we're looking at with AI, at least for the near, intermediate, and maybe even long term. So again, like we go to convention and we see, all the vendors are around in the hall and like that to me, those are the people where the opportunity is. It may be accounting software, scheduling software, diagnostic software, valuation
Right.
tools, right? How do we know what this trade-in is worth to the minute? What can it be worth at retail? Like it's all that stuff to me that AI is going to impact. It's not replacing anything. It's certainly not immediately, but I think it will be the driver of where the earnings catalyst will be. And to me, that's the operating expense lines.
Right.
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 So the idea of, we're going to buy low and sell high, and we're going to drive this with our gross profit, to me, in a mature market, that's very difficult to do, right? But
Yeah.
you have the tools to impact your operating expense lines. And I think that this is coming out of the pandemic period where it was all about front end gross on new, used,
Right.
fixed ops, F&I, right? Like it's okay, that's not that anymore. It was great while it lasted, a lot of fun, great for valuations, but now we got to do a little bit more work on ourselves, on our own business and be efficient on the operating expense lines. And I think that's, but I agree with you. It's going to be annoying as hell that everywhere we go is going to be about how
Yeah.
AI, fixes the world and it's the answer to everything. I
Yeah.
think it's a
I think from my perspective, it's one of those. And you said this: efficiencies, efficiencies, efficiencies. But I also think that part of consumer convenience, right? We get sometimes as in our world, we can get so hung up on the efficiencies and all the different things. What's going to make it the easiest to acquire new customers, to attract new customers, to get them to you? What tools can you employ to grow that part, to get more of those opportunities? To me, that's the part I find really interesting. I feel like we're in kind of where the internet was all those years ago when it just came out, and you had some in the dealer community saying, I don't want to really understand the internet. I just want to know how we stop it so we can just keep doing what we've been doing. And now here we are with AI. And, I think what I'm hearing you saying and what whether you like it or not, it's here. The business is going to evolve. It's going to change. You have to at least be aware of it, consider it, and find out where it fits in your overall organization, both from a cultural standpoint and where you are and what you're trying to accomplish.
look, and I think again, it goes back to the idea of choice, right? And it's what makes the world go round, or at least this country go round, is that
Right.
you're going to have people who want to buy a vehicle completely online. I don't want to
Right.
interact with anybody.
Yeah.
I will pay the price that's on there. I will take this financing package because it works for me. I will extend my warranty. I will do this, and I will DocuSign.
Right.
And if I have to, I'll come and get it. If not, send it to me. Then
Right.
you're going to have people at the other end of the spectrum, like my wife, who just likes to go and fight with salespeople, which I'm all for. I'm all for, not because of the deal that she gets, just because it's somebody to fight with other than me.
Right.
So
There you go.
just go, just go and get your yayas out, there, and
Uh,
then right, and then there's going to be everything in between. And I think that the franchise base and AI is going to be the things that enable
yeah.
eventually the process to be completely online. And maybe that's 1%, 5%, 20%, 50% of the market. Maybe it grows. Maybe people are always going to want to go and see it and smell it and touch it and
Right.
drive it.
Right.
And that's, I think, what this industry is about. Is it's about that choice, right? Not everybody wants a minivan. Not everybody wants a roadster convertible, right?
Right.
There's all. Not everybody wants to not interact with a human. Then not everybody wants to be full contact,
Yep.
interaction with the dealership. So I think it's important that the dealers understand that there is same thing, right? There's a segment of the market that wants to drive electric vehicles, right? And
Yep.
it may grow, it may not. There's a segment that want big full-size pickup trucks, internal combustion, like there. So I think what AI is doing is it's enabling access or to meet those people wherever they are, right? And
Yep.
that's not going to stop, even if it's not, even if it was something other than AI, right? It's what history has been all along.
Yep.
We improve processes, right? And it's an improvement in the process. And you're never going to stop it. It's never been stopped, right?
Right.
You're just going to figure out how to make it work for you.
And as long as we continue to be a market-driven economy and economy and of choice, then that's absolutely will continue to be the case. Kevin Tynan, I know we're up against the time, but I certainly appreciate your time with you. There's lots of chuckleheads we can listen to out there, but this is the one we like to listen to. I laugh because I steal Kevin's word on that. I just find that a great word. But we're very excited that you spent some time with us today. And for those that are already considering, we're only 6 months out really from our next convention, which will be June. Kevin is there each year. He'll be there again this year. So we look forward to seeing you and keeping up to date on things. So again, thank you so much for your time.
Always my pleasure. I'm very much looking forward to convention and seeing everybody again.
All right, everybody, that concludes this edition of Kentucky Horsepower. Enjoy the holiday season, and we'll see you next time on KDA's own Kentucky Horsepower. Thanks again.